Yes, hello and good evening to everybody. So our revision session, the fourth revision session is going to start now. And until yesterday, we had done chapter 3, unit 1 and unit 2. So in this lecture, we are going to cover the unit 3, that is the last unit of chapter 3. And we are going to start with the fourth chapter, first unit. And how much ever possible, we will finish up in this session. So what is unit 3 of chapter 3? We all know the name of this unit is monetary policy. And as I told you in the beginning of our classroom discussion, as well as in the first revision class of this series, that a business cycle which is high in variation needs to be smoothened with the help of two types of policies. And those two types of policies, we call them as fiscal policy and monetary policy. Fiscal policy part we have already covered in chapter 2 revision. So we'll be covering the monetary policy in this particular unit. So the question comes in front of us, what do you mean by monetary policy, right? What is the definition, or how do you describe monetary policy? It is nothing but the use of available tools and instruments with the RBI to do what? To make sure that adequate money and credit is available. At the same time, the interest rates are optimal, right? Now, this is to make sure that RBI has this responsibility to do this. Also, there are again those idealistic points that RBI has to ensure with the help of monetary policy. What they have to achieve? They have to achieve long-term economic growth. Long-term economic growth. There has to be price stability and other points such as what your less unemployment, and also controlling inflation, and all the other things will follow, right? These are like, if you ask somebody, what do you mean by monetary policy? What are the aims of monetary policy and all that? You can start with this definition, right? Then we have to understand the RBI's objectives, the central bank's objectives from the point of view of RBI Act as well. We know that there is a Reserve Bank of India Act, and it gives two different objectives for RBI. They're very objective based objectives, right? When I say that, it is very specific in its terms because it is law. It says the RBI's responsibility or aim is to issue and regulate currency notes, and also using of credit system to its advantage. Right? These are the two objectives which are given by what RBI Act, right? And generally, what are the objectives? This is also very important that we need to know. If the question comes tomorrow in the examination as to what are the objectives of monetary policy, you are supposed to write this, right? And this can also come as what are the objectives of the central bank in an economy, right? These points can be written. First one is first of all balancing between price stability and economic growth. Now, let me give a small example here so that you'll understand what I'm talking about. Why price stability and economic growth can't go hand in hand. Let me tell you. When aggregate demand is very high, what is going to happen? In an economy, inflation also is going to be high. But whether having a high inflation is good for price stability, answer is no, right? So to make sure that the prices are stable, you have to control the inflation. But when you control the inflation, if you reduce the inflation by your monetary policy, what is going to happen? The aggregate demand also will fall down. When aggregate demand falls down, what will happen? There can be a chance of unemployment in the economy, right? There can be chance of unemployment in the economy. So we don't want this. So it is the major objective to balance between this price stability and economic growth. Both has to go hand in hand. That is number one. Second one, is that the is flown, credit is flown to what? To the to all the priority sectors. Now, every time, you can take the example of Mudra loans here, right? Mudra loans specifically targeting the MSME sector where collateral-less loan is given. And you can also take the example of agricultural loans. You can also take the special loan facility which is available for women entrepreneurs, right? So what here the central bank is trying to do is they will identify certain priority sectors that sector has to be given a boost, right? Whenever there needs a growth in that particular sector, and it makes sure that the credit is flown to those sectors. Then there are other points, objectives such as rapid economic growth, and we know what it is, debt management and exchange rate management, and all these things will come as a objective. This is fourth point and fifth point. So whenever the question comes, you can make sure that you write 3 to 4 points, and if you write 3 to 4 points, you will get the complete marks which will be awarded for that question, right? Next, we have to learn something called as the analytics of monetary policy. You can take notes or you can observe the notes which is available, which is given. Both will give you the same level of understanding here. So monetary policy, what do you mean by analytics? Okay, first of all, let us understand something about fiscal policy. And that will tell us why we need analytics for monetary policy. See, fiscal policy, for example, let us take a small example, right? Let us say government cuts income tax. Okay, government cuts income tax. And the moment government cuts income tax, what happens? Earlier, let us say you were earning 1 lakh rupees and you used to pay 30,000 as taxes and you used to have 70,000. We call this as disposable income, isn't it? We have discussed that in chapter 1. And now what is going to happen? Government decrease the tax. So 1 lakh was your income minus, let us say now the tax is only 15,000. So how much disposable income you will have? 85,000. So with this extra 15,000, you are going to demand for goods and services. So as a result of this fiscal policy, what is going to happen? Aggregate demand is going to go up. So it is what kind of a policy? It is a expansionary policy, right? So what government did? Cut taxes. What happened? Aggregate demand increased, right? So you could see the effect of this directly. But when it comes to monetary policy, you cannot see the results directly, right? I cannot tell by cutting interest rate, by increasing the repo rate, or by increasing the CRR or decreasing the SLR, what direct effect it has given to various sectors. I cannot understand. I do not know how much aggregate demand has increased or decreased. I will not understand what effect it has on the share market. I do not understand what effect it has on the exchange market. That is why whenever we have a monetary policy, we have to also learn about the analytics of monetary policy, right? Analytics of monetary policy. So let me just talk about it for a while. So this part in this particular unit becomes a little bit important from your examination point of view. So whenever you change anything in monetary policy, when there is a change in the monetary policy, there will be a drastic change in macroeconomic variables. When I say macroeconomic variables, the variables which are related to macroeconomic, such as GDP, such as the employment in the country, right? There will be an effect. Now, how this change in monetary policy will affect this change in macroeconomic variables is called as monetary transmission mechanism. Monetary transmission mechanism, right? So a question is possible. They can ask you in the examination for 2 marks that what do you mean by monetary transmission mechanism? That is how the change in monetary policy will affect the change in macroeconomic variables such as GDP, employment, etc., etc. So usually monetary transmission mechanism occurs in 5 different ways. 5 different ways, right? What are those 5 different ways? Let us learn that in brief, right? So the first one is interest rate channel. Now, let me explain that to you with the help of an example. Okay. Now, if aggregate demand has to go up, if aggregate demand has to go up, what do I have to do? Do I have to increase the interest rate or decrease the interest rate? The answer for that is you have to decrease the interest rate. You have to decrease the interest rate, right? The once you decrease the interest rate, tell me what is going to happen. Imagine there are two scenarios. Okay, there is Mr. A and there is the A Limited. Okay, now Mr. A has 1 lakh rupees with him, right? And A Limited wants 5 lakh rupees to do a business, right? Now Mr. A has a deposit where A Limited wants 5 lakh, right? Now imagine if you have 1 lakh rupees and if you go to the bank and you know that the interest rate, because interest rates have been reduced, you are going to earn only, let us say, 3%. Will you be interested in investing this money in FD? Answer is no. So you will hold this money in your pocket and you might spend. So here what happens? Aggregate demand will go up. At the same time, look at A Limited. They want how much? They want 5 lakh rupees as loan. Now tell me, interest rates have cut or interest rates have increased? Interest rates have cut, which means the bank loan is available at cheaper rate. So what they will do? They will borrow this money and they will use this money to demand for lots of goods and services. So here also aggregate demand will go up. So if you want to take the aggregate demand up, then what you have to do? You have to decrease the interest rate. Now this is how interest rate channel will affect what? The aggregate demand as a macroeconomic variable. The second channel, that is about the first channel, interest rate. Let us learn about the second channel. Now that is called as exchange rate channel. It is called as exchange rate channel. Now what happens in exchange rate channel? Let me explain that to you. In your CA final, you are going to learn about a concept called as interest rate parity theory. It's not very important for you to learn that now, but just understand this. It says only this much, that if an interest rate in a country is higher and interest rates in another country is lower, the country where interest rate is higher, the currency will get depreciated. Okay. And now how to do that? It's very simple. See, imagine a situation where $1 is equal to 100 rupees, right? And now imagine that in US, the interest rate is 5% and in India, the rate is 10%. So here the dollar will grow by 5%, where rupee will by 1.1, that is 10%. And if you calculate again, what is $1 is equal to, that is 100 rupees into 1.10 divided by 1.05, you will get answer roughly 110 divided by 1.05, around 104, right? Around 104 will be the answer here. So what happened? Earlier, the value of $1 here was 100 rupees. Now it is 104 rupees. So you can say that dollar increased in value. At the same time, you can say that rupee decreased or rupee depreciated against dollars, right? So this is how interest rate over here, right? You can see interest rate over here affected the exchange rates, right? This is how it affects the exchange rate through exchange rate channel. That is about second monetary transmission mechanism channel. Now the third one that we are going to learn is called as quantum channel. Right? What is quantum channel? Now in quantum channel also there are two different things. First one here is bank credit channel. Bank credit channel. Second one is balance sheet channel. Okay, first we'll talk about bank credit channel. Now, bank credit channel is nothing but something called as open market operations. Now, I'm going to cover that in the later stage of this discussion. Open market operations, what are them? Basically, what it is, see, whenever there is a change in the, the interest rates of government bonds, the treasury bills and RBI bonds, etc. There are certain banks which are not very keen upon giving their money just for the purpose of increasing the credit. So they will look at opportunities where they can invest money risk free, right? So there are certain banks which will directly go and buy these treasury bills and bonds and all that. And with that, what will happen? The money supply will move from the bank's hand to the RBI and RBI's hand to the bank, and a lot of transaction in between will happen, which indeed will turn into increase or decrease in aggregate demand. This is what the bank credit channel is. Yeah, the open market operations I'm going to cover on the later stage when I'm discussing tools and instruments. So don't worry about that. Now let us get into the second part, that is balance sheet channel. Now this balance sheet channel also, there are two different bifurcations over here. First one is a direct channel, and there is indirect channel. Okay. Now, what is direct channel? Let me, explain that one to you. Imagine that, there has been a floating rate loan which is taken by a company. Floating rate channel means what? It is floating rate loan means what? Initially, you might have, taken loan on a particular rate, and later when the RBI changes the interest rate, your loan rate will change, and with that, your liability of the year will increase or decrease, right? Whereas the change in the interest rate, which is done by the RBI, is having a direct effect on your expenses, right? Every year you have to pay, but the interest rate is completely depending upon what is the interest rate cut made by RBI or interest rate increase made by RBI. That is how it directly affects your P&L. At the same time, there is, indirect channel. Indirect channel means you can talk about this, that in the yesterday's class we told that whenever the market interest rate increases, the bond price will fall, and vice versa, right? So if there is any change in the interest rate made by RBI, the bond prices will either increase or decrease. And if you as a company has an investment in these bonds and you have held it at fair value, then it so happens that your value, right, the fair value of your investment, of your asset will change. This is how it indirectly affects your balance sheet. So this is called as what? The quantum channel, the third one. And then let us go to the fourth one. The fourth way in which it affects, right? It is called as asset price channel. Asset price channel. Now, what happens in asset price channel? Let me explain that one to you. Here, there are two different markets and there are two different players, right, in the market of investment. One is the people who play in the bond market and the people who play in the share market, right? Now, imagine that bond market used to give you a return of, let's say, around 7%, right? And whereas share market, it used to give you a higher return of, let us say, 16 to 20%. Right, 16 to 20%. And whenever I say share market gives a higher return, it carries a higher risk also. The bond market doesn't carry much risk. Okay, it carries risk, but not to the extent of share market. Now, here what happens? Imagine that the interest rates increased and from 7% it has grown to 12%. Now, tell me, when bonds are giving at a lesser risk, 12%, will people be still interested in going to the share market? That is a very important question to be answered. Now, what happens whenever the rate changes from 7 to 12, right? Some proportion of this share market investments will come to bond market. Now, this is how the asset prices will get affected. Okay, because people will be leaving the share market, they might be dissolving their portfolio, and with that, there can be changes in the prices of shares and all that. And all this happened how? Through a change in the interest rate which happened, right? Although I have given a very big difference, 7 to 12%, those kind of changes are very, you can say next to impossible. That kind of changes, they are very difficult. And you can expect a small change. And when your quantum of investment is huge, right, those small changes in the interest rates, a few basis points can make a big difference, right? That is about your asset price channel. Let us go to the fifth channel. Now, the fifth channel is called as expectation channel. Now, I don't have to say anything about this channel because whenever RBI changes interest rate, there is a lot of expectation made by the people about what is going to happen in the future. And that panic itself creates a lot of changes in the macroeconomic variable. That is nothing but your expectation channel. you expect whether the rate is going to affect certain asset prices and what is going to happen in the future. People start speculating and start trading on that, and all those things are which happen, right? So these are the 5 different channels in which a monetary transmission mechanism works. Okay, I hope these 5 points are clear to you. Now, for the examination purpose, any of this channel can be lifted and asked for 2 marks, 3 marks, or 4 marks. Or they can ask you a 4-mark question where they will ask you what is monetary transmission mechanism and what are the 5 different channels of that, right? So you should be able to answer this quickly. I'm sure that you are able to appreciate, because if you have gone through this once, you'll be able to appreciate it faster, right, in this revision lectures. So let us go to the next part of our discussion. That is going to be the monetary policy instruments. Monetary policy instruments. Now, in this monetary policy instruments discussion, we are going to divide these instruments into 2 different parts first, right? What are the 2 different parts? You should remember. One is direct instruments, and there are indirect tools and instruments. Now, what comes under direct? Simple. You get CRR, that is cash reserve ratio. You will get SLR, that is statutory liquidity ratio. And there are directed credits, and there are administered interest rates. Now, let me just explain what are directed credits. Directed credits are nothing but RBI will say nothing doing, right? Every bank has to concentrate on giving credit to agriculture because we have had famine, right? No, if something like that happens, RBI will direct, definitely, right? In the year 2015, if you remember, right? So there was a circular which was given by the RBI, which clearly stated that up to a certain extent of loan, of course, it was done through NABARD, but in the cooperative societies was supposed to be given interest free to the farmers, right? So they directed that credit has to be flowed to that particular sectors because those sectors must be in trouble because of the economic turmoil or some scenarios which are outside the control of the country's economic policies, right? And what is administered interest rates? It is simple. See, there is always for senior citizens, you have to give a higher interest rate on their FDs, or for women entrepreneurs, you have to give a lower interest rate. For certain sectors which are suffering because of corona, for example, you can the cargo handling, the custom house agents, and they have had a very big losses in the year 2020 and 2021. So there is a directive which says that a certain interest rate concession has to be given to certain sectors and all that. That is nothing but administering the interest rate whenever RBI has the power. So these 2 things we have covered, right? Indirect method. Now, in the indirect method segment, we will have LAF, that is liquidity adjustment facility, and there is MSF, marginal standing facility, and there is open market operations, right? And there is one more thing which I will tell you later, because it's not a part of our syllabus directly, but it is very important to know to write the answer very effectively. So we have covered this directed credits and administered interest rates. So let us go to CRR. What is CRR? Cash reserve ratio. The RBI tells that banks have to maintain the banks have to maintain, right, with whom RBI a certain percentage on their NDTL. What is NDTL? Net demand and time liabilities, right? So RBI can direct this, but what gives power to the RBI? It is simple. It is section 42 of RBI Act, which gives the power to the RBI to make sure to tell the commercial banks that this is what you have to do. You have to keep certain percentage with me, right? Being RBI. And for cooperative banks, it is section 18 and section 56 of Banking Regulation Act of 1949, right? So this gives the power to the RBI to do the same rules with regard to cooperative banks, right? Tell them that this is a cash reserve ratio which you need to maintain. Now, what happens here? The banks have to maintain it with whom? Banks have to maintain it with RBI. That is a major point that you have to remember about CRR. Now, an interesting fact about CRR that we have seen that in the year 1990s and all that, CRR used to be how much? More than 15%, 15% and above, right? Which means if the NDTL of SBI, if it is 100 crores, right? If it is 100 crores, which means now it is somewhere around 3%, right? So you have to keep. Let us take an example. I can go to the website right now and check, right? But if you want to check, you can go to RBI's website right now. On the left side top corner, you can see all the policy rates which are there. So there you can check, and you can say CRR. If it is 5%, I'm doing it for convenience purpose. So how much will be remaining? 95 crores will be remaining. So out of these 95 crores, the SBI can go for giving credit, okay, to the people. Of course, SLR is yet to come. After SLR comes, we will have much more clarity. So you have to keep this reserve with whom? With RBI. I hope that is clear to you, right? So next, with that, we will go to the next one, that is SLR, statutory liquidity ratio. This power to direct for statutory liquidity ratio. First of all, what does the statutory liquidity ratio mean? Let me put a thought in your head, and imagine that you have deposited 1 lakh rupees in ICICI Bank, and ICICI Bank wants to lend that money to somebody else to earn money, right? You have kept 1 lakh rupees, means you also need interest on that, so definitely you will be demanding for interest 1 year later. So ICICI can't just take that 1 lakh rupees and keep it in the locker, and next after 1 year they can't open it. They have to do business with it, so they like to go ahead and give it as loan. But can they give that entire 100 rupees loan? Answer is no, because the moment you give 100 rupees loan, what is going to happen? Tomorrow something happened and you want to come back and take that 1 lakh rupees back, and that time, if the bank doesn't have money, that situation in the banking world, we usually call it as bank runs. We might have seen about some of the urban cooperative societies which are recently they have gone bankrupt, right? So what happened? Some news got spread that something is going on in the bank, and next day bank run started. People wanted their deposits back, and definitely you have given all the money as loans, right? And you don't have that money back to pay to your depositors, right? That kind of problems will arise. So to make sure that the liquidity problems in the bank doesn't arise, a statutory liquidity ratio is always preferred by the RBI to the banks, right? So statutory liquidity ratio, the power to direct this has been given under section 24 of Banking Regulation Act, 1949. Now, whether writing these sections is important? No, writing these sections is not important. But if you write these sections, if you remember these sections, and if you're able to write, right, that gives a special weightage to your answers, right? So the examiner will definitely, be impressed with your writing, right? And this will help you, showing your knowledge in this particular subject. So what is it with the SLR? Where to maintain it? How to maintain it? That question can be answered like this. You have to maintain it either in cash or in gold or in unencumbered securities which are notified by RBI. So you have only three options here. Either you keep that in cash, or you keep that in gold, or you keep that in unencumbered securities which are notified by RBI, such as treasury bills, government securities, etc. Right? And RBI has given a elaborative list. Okay, the list had come out a couple of months back where they had added certain securities to that segment. Right? So if you are more interested in this topic, you can go to RBI website and you can check what are the various securities which are notified by RBI. And the interesting part about is the CRR you have to maintain with whom? You have to maintain with RBI, but SLR you will maintain with bank itself. You have to maintain it with yourself, right? If you are the bank, you have to maintain it with yourself. So that is with regard to SLR. I hope the concept of SLR is clear to you. So let us go forward, right? What is next? We finished all the direct, instruments. So let us go to the indirect instruments such as LAF. Now for that, I will take an example. Imagine, right, liquidity adjustment facility. Imagine that SBI had 100 crores and out of that they kept CRR of 5 crores, and the SLR, imagine it is 15%, so SLR of 15 went off, right? So what remained? 80 remained, which means this 80 crores I can give it as a loan to people, right? I can give it as loan to the people who deserve it, the people who have capacity to pay it back, right? But it was a very dull season, and SBI thought, why should I give so much of money in loans? I can give loans only up to 70 crores, right? And 10 crores is still remaining with me. That 10 crores, what will the bank do? Probably they invested in, let us say, government securities of 10 crores, because the economy was going dull at that time. Imagine after 2 months something happened, and a festival came, right? Let us say Diwali came. At that time, what will happen? The people want more money to spend, more money to invest in their business, and more money to everything, right? At that time, people started asking, but these government securities have not yet matured. So at that time, what will you do? There is a facility given by the RBI. RBI says to SBI, you give me that 10 crore worth of government securities, and I will keep it, you keep it as a collateral with me, and you take money for now, and and SBI will repurchase these government securities, repurchase these instruments at the end of a specified period. Let us say 1 month, 3 months, 6 months, 1 year, right? So you will buy back that securities after a specified time, right? Sounds like a good deal. So this LAF is also known as repo agreement. You might have heard about this, right? Repo rate. Repo rate means repurchase agreement. That is, I kept these government securities with RBI as collateral, and after a specified time, I will take it back, right? After my requirement is done. So this facility is called as what? Liquidity adjustment facility. That is, whatever excess that you have invested in government security, treasury bills, etc., you can keep it as a collateral with RBI. I'm using the word collateral only to make you understand this concept, right? So you can keep it with RBI, take money, right? And later point of time, you can buy it back, you can repurchase it back. And while repurchasing, definitely you have to pay a particular interest, right? So they are giving you 10 crores over here. So you have to give, money, what? In like a certified percentage, which is declared by the RBI. That is called as the repo rate, policy repo rate. You can find it again in the RBI website on the left side, top corner. You can find these rates. What are the current rates? Okay. Now this is with regard to what? This is with regard to LAF. Now let us go into the next one. The next one is called as MSF. That is marginal standing facility. Marginal standing facility. Now, what is marginal standing facility? Let me explain that. Right. So it's very simple. It's nothing difficult. SBI had how much? 100 crore. SBI had 100 crores. And out of that, CRR was how much? 5 crores. And SLR was how much? 15 crores. And what remained with you? 80 crores. Now this 80 crore you can give as loan. Imagine that entire 80 crores you have already dispersed as loan, and now again a requirement of 2 crore has come to you. Again a requirement of 2 crore has come to you to give it as loan. But do you have money? You don't have money. Now, do you have any government securities through which you can keep collateral with the RBI and utilize your LAF, that is liquidity adjustment facility? Answer is no. At this moment, you can actually dip into the SLR. You can dip into what? SLR, which you have kept with yourself in the form of cash, gold, or government securities, and you can take money from RBI. Now, this is allowed only for scheduled commercial banks. This you have to remember. This marginal standing facility is given only to whom? The scheduled commercial bank, and they say that maximum loan that you can take out of this facility is 1% of your NDTL. All this information is not there in the textbook, but you can write it in the examination to get, actually to show the better knowledge that you have, right? So 1% of NDTL means you want 2 crores, but how much you can take? Only 1 crore, right? Marginal standing facility has an upper cap, and this is allowed only for whom? This is allowed only and only for the scheduled commercial banks. Even regional rural banks do not have this facility. Okay. Now, with that, we finished MSF, and we have to go to the other tools which are there, right? I told you there are some other tools which are there. So let me explain to you. First one is open market operation, right? I told you at that time, I will explain what open market operations is. Imagine that the commercial banks such as SBI, your HDFC, Axis Bank, Yes Bank, and your Corporation Bank, like Canara Bank, they all have lot of money, right? And when they have lot of money, what do? They try to give it as loan, right? And when the supply of money is more and the demand for money in the economy is less, what is going to happen? Interest rate is going to fall, and people are going to get a lot of money. With lot of money, they are going to increase lot of aggregate demand. And once they increase lot of aggregate demand, what is going to happen? Inflation is going to creep in. There are so many problems. So RBI is sitting here. RBI is saying that I need to take this money out, right? Whatever it is through these banks, I need to take this money out. So what RBI will do? RBI will sell securities. RBI will sell securities, and these SBI, HDFC, they have a lot of money. And when RBI is selling us securities, definitely they'll buy because it's guaranteed, right? The return is guaranteed. It is not like giving loan to some individual A or B or C, whoever can, tomorrow he can topple and, he can say, I won't pay and will become NPA, so much of recovery procedure problems for me. I don't want. I will take all this money, lot of money that I have, and I will buy these securities, which RBI is selling, right? And you will transfer all the money. And with that, what will happen? RBI get hold of all this excess liquidity in the economy. And once they get hold of all this excess liquidity in the economy, they can control what is going on in the economy through price stability, right? So this is the total, plan where open market operation is done by the RBI. At the same time, you can do opposite. What is it? Instead of RBI selling securities, RBI can buy securities. Whatever that is there with SBI, HDFC, Axis Bank, they can buy. When they're buying RBI, what they will do? They will pay money to this bank. So banks will increase in their liquidity. Once banks increase their liquidity, they'll be able to give loan in the economy, and they are going to stimulate the aggregate demand in the economy. So this is nothing but open market operation, which you have learned in very, very much detail in the classroom discussion, right? So I hope you are able to appreciate this point. Let us go to the next one. After open market operations, we have something called as MSS, that is Market Stabilization Scheme. So let me explain that one to you, what it is in very simple words, right? Imagine that Government of India is going to issue, government securities worth 100 crores, right? Government securities or treasury bills worth 100 crores. And whenever government issues these, they are usually the bigger institutions and bigger investors who are going to purchase them. Okay. And imagine that HDFC purchased 20 crores, right? And, let us say Rakesh Jhunjhunwala purchased another 20 crores, right? And RBI purchased the rest, because government anyway needs money, right? So if nobody purchases also, RBI will definitely purchase, right? So government got their 100 crores. In 1 year, what is going to happen? For the sake of argument, let us keep the interest rate as 10%. So what will happen here? HDFC after 1 year will get 22 crores, 10% increase. Rakesh Jhunjhunwala also will get 22 crores, right? And RBI will get 66 crores, right? Now what happens here? Excess money is being transferred, right? Here how much? 2 crores excess. Here also 2 crores excess. Here 6 crores excess, right? And when there is excess money flow into the economy, what happens? What happens when there is excess money flow? The aggregate demand will increase again, right? So inflation will creep in again. So it's a big problem, right? So to control this problem, see, major part of this problem is controlled. How? This 66 crores is given to whom? RBI only. RBI will not give it to anybody else. RBI will keep it very close to their pocket, They say that we are not letting this go into the economy, right? So here what happens? Here we will get, HDFC will get extra 2 crores. Now what will HDFC do? HDFC will definitely increase their what? HDFC will increase their credit facilities, and they will let this money flow into the economy. But RBI doesn't want this to happen. So there are certain things that RBI can do. RBI can prescribe a rule in which HDFC has to keep that 2 crore rupees with RBI, right? They can increase the ratio such as CRR or SLR, right? And to an extent, let us say they cannot do this unprecedented changes and all that. So they can, to an extent, they can control what HDFC does with that extra 2 crores. But what about Rakesh Jhunjhunwala? For that argument's sake, right? There are so many other institutions, private institutions, which buy the securities also. So they don't come under any Banking Regulation Act guidelines. They don't have to follow the RBI Act, right? And they don't have to follow so many other rules which are made by the RBI for the bank's purpose. So what will Rakesh Jhunjhunwala? How can you control him? Only if you are able to again sell him securities worth 22 crores, you cannot take that money back, right? The only way you can take that 22 crores or even that excess 2 crores is by offering new securities. But tell me, when government redeemed this 100 crore worth of securities, they redeemed the securities which are held by RBI also, which means does RBI have anything to sell? RBI also doesn't have anything to sell. At that time, RBI has this special power in which they can issue securities in the name of the government to this individual, and later on they can adjust this facility with the government, right? So basically creating securities out of thin air, isn't it? So that is what usually we accuse crypto of doing the same thing. You are taking value out of nothing, right? And this kind of facility to adjust the market, to stabilize the market, even central bank of the country will do this, right? Taking money out of thin air, taking securities out of thin air and selling it to institutions which cannot be controlled otherwise. Now this scheme, right? You call it as market stabilization scheme in simple words. Okay, so this is with regard to MSF or market stabilization scheme. Next, we are going to learn something about the bank rate. What do you mean by bank rate? See, the LAF facility which we learned, right, previously, the liquidity adjustment facility came into existence in the year 2000. So before 2000, what people used to do? The people in the sense, the commercial banks, whenever they wanted money, they had securities, right? And LAF facility only came in 2000. So pre-2000, they used to go to the RBI and they used to discount their government securities. Now, this discounting procedure you have learned in accounts, right? You know how to discount the security. You might have learned about bills, bills of exchange, right? In that you have learned the concept of discount. It's a similar concept, right? Where you sell it at a particular rate, where the person who is giving you money will have some gain in the form of discount, right? So RBI had this facility of discounting. Now, for the purpose of discounting, they used to use this rate called as bank rate. Okay. So today, bank rate concept is redundant. It is not used, right? And still, why you are learning, I will tell you, right? So even though bank rate is not used actively, why still bank rate is still announced? Okay, let me tell you about that. You know that you have to maintain CRR, you have to maintain SLR, right? So CRR and SLR, if you do not maintain, there is penalty. Okay. Now this penalty is nothing but the bank rate. These penalty clauses say that your penalty will be based on the bank rate. That is bank rate plus something you have to pay. So only as a reference rate for the penalty for not maintaining CRR and SLR, we use the bank rate today, right? So in probably in some months or years, even this concept can be disposed of, right? So this is nothing but the bank rate and the concept behind it. Okay. So with that, we have finished. Only one small concept, which is the organization structure of monetary policy decisions, which you can read it on your own. There is nothing for me to explain, nothing difficult, right? So we have finished the third unit of third chapter, and with that we have finished the third chapter revision. So any doubts are there? Now it is the time to put it up. So if I see the doubt in the next 1 minute, I will answer. or I will go to the next unit. Yes, to all the people who are saying hi, hello, hi, hello. I hope your revision is going great. I will go to the next unit and let us discuss about the fourth chapter there, right? The name of the chapter is International Trade. International trade. I told you that none of the economy in today's world can work in autarky, right? That is, we can't be closed and say that our economy will thrive. It is not possible. You have to involve your country in international trade to grow into new dimensions to become a better like performing economy. So international trade is very important, right? So in the first unit of this chapter, we are going to learn about the theories of international trade. We are going to learn about the theories of international trade. Now, what are we going to learn here? Right? First, we are going to, like in the textbook and even in our discussion, we started with what is international trade. But what is international trade is not something that we would do in revision class, right? A trade between two countries is international trade. There is nothing, technical about it. Although the definition which I have given in the notes is important, please go through that. And if a question comes as to what is international trade, that can happen only if you're extremely lucky, right? And you should be able to give a proper answer. Now, what are the various arguments in support of international trade? That is the second major question. That is the arguments in support of international trade, and there are arguments which are against the international trade, right? These two questions are very important. Now, what is the arguments in support of international trade? That is, international trade is a very powerful stimulus to economic efficiency. You can take the example of India only. In the 1990s, when we globalized our economy and started the liberalization, globalization, and privatization, our economic growth has gone tremendously high from 1990s to what we are today, right? And even drastic changes have come in our banking system. In our earlier we discussed in the third chapter last unit, few minutes back, we discussed about these rates of CRR, SLR. You won't believe, in 1990s and before, the CRR was 15%, the SLR was up to 38%. That is around 53% of the money used to be kept idle, right, in the form of either you have to keep it with the RBI or you had to keep it with yourself in the form of gold and cash, right, at that time. But imagine how difficult it was to get loan at that, right? And the interest rate was very high. That is, banks, if they had 100 crores, 53 crores they had to keep with RBI and other assets, right? And only 47 crores they were able to give loans. So it was very difficult. And once we liberalized our economy, then that kind of thing cannot be done, right? You have to make sure that people get money to become competitive in the international market, right? So that is international trade has very powerful stimulus. Even while changing how the economy functions in a country, it has that much effect, right? And you get the access to new markets whenever we go into the new economy or new country. You export your products, and your products could have a cost advantage for you, and you will be able to get bigger orders. You will be able to scale your business, become a leader in that particular segment. International trade also enhances the extent of markets and augments the scope of mechanization and specialization, right? So all the technology which moves from one country to another country, because of this international trade, you get a better quality of goods, right? Today, if you're using a very nice electronic, probably you are using Apple product, Samsung product, thanks to globalization, right? So the technology flew from some other country here, the manufacturing happens in some other country, and you get that device in your hand, right? We are actually lucky to be there in this particular point of time, rather than living in 1960 or 1950s where we used to get nothing, right? And employment generation happens because of demand increase. Investment will move from one country to another country. There are so many arguments in favor of international trade. At the same time, there are so many arguments which are against international trade or trade openness. They say that the possible negative labor market, which is an outcome in terms of labor saving technological change that depress demand for unskilled workers, isn't it? Right. So there are like look at the banking scenario in our country. Before the introduction of core banking system and efficient systems in the banking sector, the number of employees in the banks were huge, right? And they were all given voluntary retirement scheme and said that now we have softwares and now we have machineries to do this work. So please take a voluntary retirement scheme and sit at home, right? So that decision came into that is we are at least talking about skilled labor. Imagine what would happen automatic technology or machine coming into a particular manufacturing segment where these unskilled workers work and they will go out of job because of technological advancement. So it is said that labor will have a negative effect, especially the unskilled labor, because of globalization or trade openness, right? And it is also said that international trade is often not equally beneficial to all the countries, right? So unequal market access is there. That is, there are some developed countries which form this very strong networks of countries, and they have high level of technology, high level of machinery and all that, and they are able to always exploit and loot from underdeveloped and developing countries. All these kinds of arguments are put forward. Also, it is excessively criticized for stress on export and profit driven exhaustion of resources, right? So you look at the countries like Venezuela, right? What is happening is sort of the richest country in terms of petroleum, richest country in terms of gold, and richest country in terms of diamonds, right? But the economic stability in that country is so disturbed. That is because of the often clash between the government, which tries to be socialistic, but there is corruption creeping in the economy, and there are a lot of problems. That is because of the international trade and the the lobby which comes from outside the country, where they are trying to deplete that country of natural resources. Now these are the problems which are real, right? And probable shift towards consumer culture and change in the patterns of demand in favor of foreign goods, right? What do we want in our country will never be given importance when exports will be maximum, right? People only care about what do our importers want. That is, what do people sitting in foreign countries want? Who cares about what people in our own country want, right? Those are the arguments which are put forth against what the international trade. And trust me, these arguments are given in multifold arguments are given. Many points are given, 8 to 10 points are given. So what you have to do, you have to go through all the points, right? And you should remember at least 4 to 5 points to make sure that you can write that in exam and get good marks, right? And all these points shortened and given in our notes, which you can easily go through and you will understand everything which is written. Okay, shall we go to the next one? Yes. Now, next we are going to learn something called as international trade theories or theories of international trade. And in that first one, we are going to learn about the mercantilist theory or mercantilist view of international trade. Now, what is mercantilist view? Let me tell you. It looks at international trade like this, that one country's gain is another country's loss, like a zero sum game. You win, I lose. There is no win win situation, right? Now, this is called as a mercantilist view, which says that increase your exports and decrease your imports, right? And if everybody exports, right, who will import? That is a very pertinent question to be answered, right? So, mercantilist view puts in this unhealthy competition where people will only push exports and people will restrict imports to make sure to reach a good standard in economic growth. Now, with that, what will happen? One country which is stronger, which has a good restraint, will go up, whereas the other countries which do not have restraint will lose, right? So, this is what mercantilist view of international trade is, right? Then we have the theory of absolute advantage. The theory of absolute advantage. What does theory of absolute advantage say, and who it is given by? It is given by who we call as the father of economics, Adam Smith, right? So Adam Smith gave this particular theory. What is the theory of absolute advantage said? Definitely, we can't go into the depth of the concept now in the revision classes, but we should remember, right? So wherever we have absolute advantage over production of particular goods, we have to produce that goods, and other products we have to import. That's what absolute advantage says. For example, imagine that there is wheat and there is cloth, right? And there is country A and there is country B. And in 1 hour, right, country A can produce 6 wheat and 4 clothes, and country B can produce 1 wheat and 5 clothes, right? In this, you have to look at just the absolute advantage. Who has the absolute advantage in producing wheat? Definitely, it is country A, which has absolute advantage in producing wheat, whereas in clothes, who has the absolute advantage? Country B has the absolute advantage. So what they have to do? Country A has to produce wheat, and country B has to produce cloth. This is the uh, decision which will be taken, right? So this is with regard to the theory of absolute advantage. And what is the next one? The next one is theory of comparative advantage. Theory of comparative advantage. Now, what happens in theory of comparative advantage? The same scenario put forward again, where I'll give output per hour, I'll give output per hour, and I have commodity, that is, one is wheat, one is clothes, and there is country A and there is country B, and country A produces 6 and 4 just like previous, but country B produces 1 and 2. If you look at the absolute advantage, country A has absolute advantage over both the products, right? But it is said that you have to look these things in relativity, right? That is, you have to look at how much wheat is worth in terms of cloth and how much cloth is worth in terms of wheat to get to the answer as to who has to produce what. And that will give you a surprising answer. And we have seen that by working it, in a very long video of around 25 minutes, we have done it on that. And we have explained how comparative advantage is satisfied, right? So I'm not going to the depth of comparative advantage. It will make this video another longer by 1 or 2 hours, right? Which we cannot afford during your, revision session. Although in Indigo Learn channel, there is a video which is explaining the comparative advantage theory, which you can definitely go and watch, and you can understand if you are not yet understood about the comparative advantage theory. And with that, I will go to the fourth theory, that is going to be the Heckscher-Ohlin theory. Okay. Now, Heckscher-Ohlin theory is also called as factor endowment theory. Now, what this theory says, in very brief, if I have to explain to you, it says that every country has its own factor endowment. For example, certain countries are rich in having capital, and certain countries have been rich in having labor. So you have to identify, being a country, what is that endowment that you have got, whether it is you are a capital rich country or you're a labor rich country, and you have to produce your products based on that itself. If you are a capital rich product, you produce capital intensive products. If you're a labor rich country, you go into the service sector, all labor intensive products, right? That is what is explained. And if you look at India, right, how we shifted swiftly from manufacturing segment to service sector, right? So because we have a lot of labor endowment in our country, right? And then there are some another theory which is there, the fifth theory, which is called as a new trade theory. I will just give an introduction to that also. New trade theory. Now, what does the new trade theory tell us? It's very simple. It says that the economic from the 1970s, okay, to be very precise, from the 1970s, the new trade theory helps us in understanding why developed and big countries form something called as trade partnerships. Okay, if you look at the companies which have come up in the US, right, they have strategic partnership with the countries which are there in Europe, or the countries which are there such as Canada or South American countries. They have a strategic partnership, so they create these partners, right? And with that, these countries are able to uh, grasp, or they are able to make 50% of world trade. Okay, world trade happens only with those few countries which have the strategic partnership. So the new trade theory says that because of substantial economies of scale and the network effect, there are two things. What is the first one? Is the economies of scale. When you purchase in a very high quantity, you can get that in a lesser price compared to you go for a smaller quantity. Economies of scale is there, and economies of scale not only applies for raw material, it applies for all the other factors of production as well. And then you have something called as a network effect. So two things. One is economies of scale, and also there is something called as a network effect, right? Economies of scale, I have already told you. What is network effect? Let me tell you what network effect is, right? So it is always advantageous for a company like Apple, right? If they want to sell iPhone in India, if they manufacture, assemble everything in California and send it to India, the cost that they would bear on transportation, safety, and all those things would be higher. So they will have a nearby manufacturing facility, either a nearby country or the country which is well connected into a certain continent, right? So they will have these networks, right? And these networks will make them easily get their raw materials at cheaper prices. That is point number one, and easily to push your product into the different markets, right? So network effects. I can tell you example of Nutella. Company like Nutella, it has existence of network effect in more than 60 countries in the world. Okay, so what do they get? They get cheaper raw material, and they were able to push their product faster and in a better, cheaper way. So that is how this new trade theory explains the international trade. So all these things I have given elaborately in the notes, right? So if you want to access that notes, please download OneFin, or you can go to Indigo Learn website. Under free resources, you can find the notes for economics for finance, and you will be able to study this better. Okay. So with this, we have finished the first unit of international trade, and for today, this is it, right? So we are now, it is I'll give 1 minute. If at all anybody has to type in any of the questions, you can type it, and I will try to answer it to the best of my capacity. Okay, I take it that there are no questions. Hence, there are no questions. We will meet again in the next class. We will be discussing about the second unit, that is instruments of trade policy, and the continuing the units. Right? We will have 1 or 2 classes more to finish the entire revision of the fourth chapter. So we'll see you in the next class. Bye for now. Study well.